Hi guys, it's Stock Harry, and the Fed raised interest rates again, but it's really what Jerome Powell said and what was listed in the summary of economic projections that we really need to talk about, because this is going to affect the stock market, the economy, and you. So let's get into it. On Wednesday, the Fed raised interest rates half a point to the highest level in 15 years. Now, this was widely expected, and you would expect the stock market to go up since the uncertainty is now gone. But when the announcement was actually made that the Fed was going to do a 50 basis point rate hike, what you actually saw was the stock market sell off a little bit. And I want to explain why. But first, let's talk about the next meeting, what's coming up with that, and then we'll go into some of the details from this meeting. The Fed's next meeting is on February 1st, and based upon some of the comments Jerome Powell made during his speech, it is widely expected that the next rate hike is going to be a 25 basis point rate hike or a 0.25% rate hike. Now again, this was expected. That was pretty much priced in. 50 basis point rate hike at this meeting and then 25 basis point rate hike at the next meeting. But what changed was not so much the Fed statement, but rather what was in the summary of economic projections. And this is really why the stock market sold off. So let's get into that. The summary of economic projections did not show any significant changes in wording, but it did have a lot of significant changes in the actual amounts of what the Fed is actually predicting going into next year. This chart gives a quick summary of the Fed's projections, and you can see how they changed from the last summary of economic projections in September. Most notably, GDP for this year came in a little bit higher than expected, but next year GDP forecast is significantly lower than the forecast in September. This means the Fed is now predicting a recession, which we'll get into in a little bit more in a minute. The projected unemployment rate came in a little bit lower for this year, but it's actually a little bit higher next year. And this was something that kind of shocked people, and there were a few questions about this during the Fed speech that came after the meeting was over. Then we've got two PCE inflation numbers. Keep in mind that the Federal Reserve uses PCE and not CPI or PPI in order to determine how much to raise interest rates by. The PCI expectations are pretty much higher across the board. For now through all the way through 2024, inflation is higher than where it was expected to be in September. As a result, the expected Fed's fund rate is also higher. So it came in line with expectations this time, and again, the 25-point increase in February. But if we look at the difference, in September 2023, interest rate was expected to be about 4.6%. Now it's 5.1%, which is 75 basis points higher than what they were projecting in September. This means the Fed would not just stop at a 25 basis point rate hike in February, but rather they may do as many as 3 additional 25 basis point rate hikes in 2023. And this really had the markets concerned. It was a bit of a shock. We thought the Fed would be done after their 25 basis point rate hike in February, especially with 2 lower CPI or inflation reports in a row. But that's not what they did. They actually came in a bit hawkish compared to expectations going into next year. Looking at the dot graph, which is a quick way of looking at Fed's range of expectations for interest rates going into the future, it was unanimous to do a 50 basis point rate hike at this meeting. But going into the end of 2023, while we are expecting a 75 basis point rate hike on average, there were 5 FOMC participants that expected rates to go up 1% next year, and there were 2 who expected rates to go up 1.25% next year. So not only did the average interest rate increase go up, but on top of that, some of the projections are for a significantly higher rate increase next year. Now, these graphs show expectations for this last meeting compared to where they were in the September meeting. And the dotted line here shows where the graph was in the September meeting. The solid blue line shows where it was at this meeting. And starting with GDP, for 2022, you can see that GDP is coming in higher than what was expected. But next year gets kind of interesting. So for 2023, The expectations were for possibly a slight increase in GDP, but now the expectations are for a flat GDP in 2023. So GDP expectations have come down, and this means the Fed sees that the likelihood of a recession is now much higher than it was in September. The Fed didn't go as far as to say that, yeah, we're going to have a recession next year, but Jerome Powell certainly didn't deny it either. He left it open as a very real possibility. Looking at unemployment rate projections, this was another interesting one where unemployment's coming in much lower than expected this year. But then we get into 2023 and unemployment expectations actually rise. And you can see 2024 unemployment expectations are higher as well. Now, this was the shocker. Why is it that unemployment came in lower than expected this year, yet next year the Fed is expecting the unemployment rate to increase significantly? This didn't really make a lot of sense. I personally think this might be a bit of hopium from the Fed that they're going to be able to get the unemployment rate up and bring the job market down. Jerome Powell says he wants to get the job market down so that supply can come in line with the demand. And the problem is right now with such a strong labor market, that causes wages to continue to increase. And we have the real possibility of a wage price spiral. So Jerome Powell is very concerned about this. He wants to see wages come down. He wants to see the job market come down. But I don't know of any employers who are even thinking about lowering wages, nor do I see a lot of employers who want to lay people off. Outside of the technology sector, there just aren't a lot because it's so hard to find and hire employees now that a lot of people are afraid to lay employees off. So I don't know if Jerome Powell's going to be able to get the unemployment rate up next year like he wants to, but I found this expectation to be very, very interesting because it doesn't seem to be grounded in reality. The other thing that was interesting, the PCE inflation expectations. Obviously, inflation came in much higher than anticipated here this year in 2022. But what was interesting is that going into 2023 and 2024, inflation expectations are higher as well. So it's almost as if the Fed is kind of giving up and saying, well, inflation's going to run hot. It's going to take a long time to lower inflation, and it's just going to be something that we're going to have to deal with. Now, you might say, well, okay, but that's just overall inflation. The Fed doesn't have a lot of control over that due to food and energy prices. What about core inflation, which removes the things the Fed can't control? Well, on the core inflation side, it was the exact same thing. Obviously came in a lot higher this year, but if we look at 2023 projections, they've gone up. So the Fed is expecting inflation to rise next year, or at the very least, just cool at a slower pace. And if we look at 2024, 2025, same thing. Inflation expectations have risen going all the way forward for the next 3 years. And these higher inflation expectations means the Fed has to raise interest rates more than expected, and they have to hold them there longer than expected also. And that's why when we look at the chart that goes over the expected target range for the Fed, it came in on the high end for 2022. Looking forward to 2023, it is a significant increase over what the Fed expected in September. Even looking ahead to 2024 and 2025, interest rates are higher than they were expected to be in September. And with all of this hawkishness looking forward to the future, you would expect the stock market to sell off and for bonds to sell off as well, which would cause yields to rise. And while we did see that a little bit, it was not nearly as large of a movement as you might expect. The stock market was down less than 1%. And take a look at what happened in the treasury markets. The 2-year treasury yield rose after the Fed raised interest rates by 0.5 point and indicated more rate hikes. Seems like a scary headline, but when you look at the actual raise that happened today compared to the overall chart, the 2-year treasury yield is still in a decline, pointing to the fact that the Fed might lower interest rates going into the end of 2023 and into 2024. And the 10-year treasury yield had the same decline despite a small rise on Wednesday. and it is in even a bigger decline than the 2-year is, which should eventually fix the 2-year, 10-year inversion that we're currently in that is pointing to a recession occurring in 2023. This disconnect in the bond markets compared to what Jerome Powell said today means that the Fed may be more dovish than they are saying that they're going to be. The Fed's unwillingness to acknowledge 2 soft inflation reports in a row is perhaps understandable, considering how long they chalked up rising prices to transitory factors, but couple that with an economy and labor market that is starting to feel the effects of the Fed's past rate hikes, and it's easy to imagine that the Fed won't be raising interest rates that much next year. And fixed income investors, that is the bond investors or treasury yield investors, appear to have concluded that the Fed's hawkishness is not believable. We saw that in the very small rise that we saw in the treasury yields on Wednesday, and we also saw that in the very small dip that we got in the stock market. So once again, the Fed has spoken and the market does not believe the Fed. It'll be very interesting to see what happens going on in the next year. Let's transition now and talk about how some of these rate hikes are going to affect you and the overall economy. Fed interest rate hikes are sending business loans to their steepest cost since 2007, breaking the 10% sticker shock level. The percentage of business owners who reported financing as their top business problem reached its highest reading since December of 2018, which was the last time the Fed was raising rates. This problem will be exacerbated by the fact that as the economy slows, the need to borrow will increase. This is because businesses have fixed costs, and as sales decline, those fixed costs still have to be paid for, which is why we often see financing increase during recessions. An economist and former Treasury Secretary said the economy may be moving into the first recession in the past 4 decades that features higher interest rates and inflation at the same time. What he's describing here is stagflation, which we have not gotten since the 1970s. This recession won't be as deep as 2008, but we also will not get a V-shaped recovery. Coming out of this recession will be slow. Margins have already been hit, and that means more business owners will cut back on investments back into the business as well as their expansion plans. Everyone is expecting 2023 will be a painful year. What that means for the stock market is the whole concept of a growth stock is pretty much dead at this point, as it will be very difficult for businesses to grow. At this point, what we really have to watch out for in the stock market is whether or not businesses can survive. A lot of smaller businesses will not be able to get financing to weather a recession, and as a result, a lot of those smaller startups are going to go out of business. We've already seen a lot of startups in the tech space who are not yet public go out of business as they were unable to get new venture capital or funding. And now this is going to start to spread into the publicly traded companies, especially some of the smaller caps that you might find on the Russell 2000. Keep in mind that during the dot-com bubble, 60% of startups went out of business. And during the 2008 recession, 40% of startups went out of business, and I'm not just talking overall, I'm talking about the companies that were publicly traded on the stock exchange. So if your entire portfolio is made up of small caps, you could see as many as 40 to 60% of those small caps go bankrupt and go out of business, much in the way that Voyager Digital and many others have done. And moving on to mortgage demand, as the 10-year, 20-year, and 30-year treasuries have started to come down, mortgage demand has gone up as interest rates have started to come down. Mortgage applications to purchase a home rose 4%, while mortgage applications to refinance a home rose 3%, although those numbers are still down 38% lower on the purchases and 85% lower on the refinances. So much like the treasuries, this was a slight increase, but when you look at the overall trend, it's still in a significant decrease. What this means for home owners, home buyers, is that we still have a lot of pain ahead into 2023. Keep in mind that in 2008, during the Great Financial Crisis, we did not see a bottom in the housing prices until 2010. So this could be a very long and very slow recovery for the housing market, and it could take very many years for housing prices to actually bottom out before buyers start to come back into the market. And here are a few other ways where the Federal Reserve's rate increase could affect you. Most people have variable rate credit cards, and the interest rate on those credit cards is starting to increase. So you'll definitely want to make an effort to pay down those high interest rate credit cards before the interest rates go up even more. And worse yet, you may not be able to make your payments. Also, consider shopping for higher yielding savings rates. The savings rates have increased significantly and are close to 4% on average. And use those higher savings rates to refresh your emergency plan. Keep in mind that during a recession, we will see a lot of layoffs, and you need a plan for a worst case scenario in case you get laid off. That means building up your savings. And once you get enough money saved in order to finance an emergency, such as getting laid off from your job, make sure you continue to save and continue to invest. As interest rates continue to rise, the yield on savings accounts is becoming very attractive. If you want more information on some of the trades that we're making in order to make money during this market, even as the market trades flat, then come join me in my coaching program where I will teach you how to trade multi-leg options, including vertical spreads, calendar spreads, iron condors, and a wide variety of other multi-leg option strategies that will make money no matter what direction the market moves in. Slots for December filling up fast, so make sure you schedule a call with an onboarding specialist now so that you can get all of your questions answered and find out whether or not this would be a good fit for you or not. You can schedule a call with an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on with these rate increases as well. And make sure you hit the like button and subscribe. And if you want to know more market news and how some of these expectations fit into what happened today, then make sure you watch the last video that I uploaded here.